Well, good evening. I wanted to share a little bit of the international perspective on this financial crisis that we're in. And this article, and I'll read a few paragraphs from this, was published on Spiegel Online today on the 26th of March 2008, and the headline of this article is "Germans Fear Meltdown of Financial System." Germany and other industrialized nations are desperately trying to brace themselves against the threat of a collapse of the global financial system. The crisis has now taken its toll on the German economy, where the weak dollar is putting jobs in jeopardy and the credit crunch is paralyzing many businesses. Bundesbank President Alex Weber was repeatedly in touch over the weekend, both by telephone and via video conferencing, with his U.S. counterpart, Fed Chairman Bernanke, as well as with the heads of central banks of other key industrialized nations. Bernanke told Weber about his organization's failed attempt that Sunday to orchestrate a last-minute bailout for the battered investment bank Bear Stearns. The venerable New York-based company, Bernanke argued, was simply too big to be allowed to go under, and the consequences of such a failure would be incalculable. For some time, there has been a tacit agreement among central bankers and the financial ministers of key economies not to allow any bank large enough to jeopardize the system to go under, no matter what the cost. But on Sunday, the question arose whether this agreement should be formalized and made public. The central bankers decided against the idea, reasoning that it would practically be an invitation to speculators and large hedge funds to take advantage of this government guarantee. Now of course, it has been made public. Everyone involved knows how explosive this agreement is. It essentially means that while the profits of banks are privatized, society bears the cost of their losses. In a world in which the rich are getting richer and the poor poorer, this is political dynamite. Nevertheless, the central bankers are running out of options, or so they say. They're anxious to avert the nightmare scenario of a financial crisis like the one that rocked Germany in 1931, when the failure of a major Berlin bank prompted a massive run on other banks by a nervous public, which plunged those banks into insolvency. For decades, a repetition of that disaster had seemed unthinkable, but ever since former Fed Chairman Alan Greenspan dubbed the current financial crisis the worst since the end of World War II, old certainties have no longer applied. So what does apply? Should the state use taxpayer money to help greedy bankers repair the damage caused by their unscrupulous speculations? Should it invest billions to save ailing financial institutions, thereby engendering new risks and side effects? And should the government, to use the words of a Frankfurt investment banker, treat a drug addict with cocaine? How does one explain to honest taxpayers that they should pony up their hard-earned money for a bank like Bear Stearns, whose long-standing CEO forked out $28 million for a 600 square meter duplex apartment in New York Central Park shortly before the collapse of his company? Or that UBS, the crisis-ridden Swiss bank, fired 3 of its senior executives for poor performance, only to turn around and pay them roughly 60 million Swiss francs, that's about $59 million, in golden parachutes. As the weeks progressed, the disaster scenarios painted by the prophets of doom, such as the American economist Nouriel Roubini, are becoming more and more likely. For months, Roubini, a professor of economics at New York University, has warned of the risks of a core meltdown of the global financial system and has summarized his thoughts in an analysis entitled The 12 Steps to Financial Disaster. And even worse off, and this is a little bit about the German economy, even worse off are companies that fell into the hands of corporate raiders like Blackstone, Carlyle Group, and Fortress during the takeover frenzies of the last recent years. From a frozen fish stick maker Igloo to model train builder Märklin to the media group Kabel Deutschland, well over 600 German companies, altogether employing over 1 million people, are now controlled by the international private equity industry. Hungry for profits, the banks finance their corporate takeovers at exorbitant prices because until recently they could quickly sell the carelessly approved loans to greedy investors. Of course, no one is buying anymore, and the market for billions in takeover loans is dead, as are many of the deals that had attracted the corporate raiders. In the wake of the financial crisis, a new debate has begun over the role of the state. For years, the prevailing dogma was that the international capital markets ought to be left largely to free market forces. But now even financial investors and top bankers are calling for more government control. This is the end of the paragraph. Now, if people in the know knew all along that the bailout plan was for taxpayers to bail out the banks, then basically everybody at the top of the pyramid certainly had nothing too much to be afraid of. And that is precisely what's happening. So essentially, we've all been lied to all these years. Let's hope this doesn't turn out to be a global financial meltdown, because I don't know what will happen to us then. Good night.